Ladies and gentlemen, I welcome you all to the Q2 FY24 post-earnings conference call of Kilburn Engineering Limited. Today on the call from the management, we have with us Mr. Ranjit Lala, Managing Director, Mr. Anil Karnad, Full-Time Director, Mr. Sachin Vijayakar, Chief Financial Officer, and Mr. Amritanshu Khaitan, Director. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, a reminder that this call is being recorded. I would now request Mr. Lala to detail us about the performance highlights for the quarter that went by, your growth, plans, and vision for the coming year, post which we will open the floor for Q&A. Over to you, sir.
Thank you, Vinay, and good afternoon to all. At the outset, I would welcome you all for the Q2 F24 post-earnings conference call. Before I proceed ahead, I would like to inform that we have uploaded the presentation on the exchanges and you may refer from there. Coming to the earnings, we are pleased to announce the earnings of Kilburn, which are as follows. The income from operations stood at 68.48 crores. The operating EBITDA was in the range of 16.79 crores, which translated to a margin of 24.5%. Profit before tax stood at 14.22 crores and after tax at 10.03 crores. The highlights of the quarter were as follows. We achieved the highest ever EBITDA margins in both the quarter and the half year. We have had a robust revenue growth with the impressive 30% plus increase over the corresponding previous quarter and half year. We have maintained a diversified order backlog of more than 214 crores as on September 30th, 2033. In Q2, we have secured orders worth 69 crores, indicating a strong demand for our products and solutions. Before I speak about the outlook of the company, I would like to inform you all about our proposed acquisition, which is currently in progress. We are in the process of acquiring 100% in a company called ME Energy Private Limited, and I would like to give you a brief about that company. ME Energy is a 24-year-old company which was established way back in 1999, and it is specialized in the field of thermal engineering. It is a leading waste heat recovery and a waste heat reutilization systems provider, which are designed to deliver energy savings and energy cost reduction solutions. These applications are found in most of the industrial applications. ME Energy factory is based at a place called Khed near Pune and is spread over 60,000 square feet both with an office and factory in that location. And there is further provision for expansion. With a deep experience in thermal engineering and a very strong project management, their solutions are customized for various industries like petrochemicals, chemicals, automotives, food, and beverages. They also include customers in the steel, power, and the carbon black industries. They have a diverse portfolio which consists of waste heat recovery units, process integrated boilers, thermal oil system, heat exchangers, air and gas coolers, and engineering solutions, amongst others. Apart from their strong presence in India, they also have installations globally in USA, Japan, France, Spain, Turkey, and Bangladesh. We see this partnership of Kilburn Engineering and ME Energy as both strategic and synergistic. The Kilburn Energy drying solutions portfolio gets augmented with the thermal engineering and heat recovery systems, since the two are complementary in nature. With many common customers and two manufacturing locations, we will be able to leverage this partnership by offering wider solutions to both existing and new customers. All in all, this partnership provides us with a strong path for our Vision 2025. We expect the acquisition to be completed by December 2023. Coming to the outlook of the company, for the second half, we expect a very healthy order booking in the range of 250 to 300 crores, which would translate into 350 to 400 crores by the end of the year. The revenue is expected to be in the range of 300 plus crores for the current financial year. And with the existing orders, we expect to maintain an EBITDA of 20% plus. About ME Energy, we expect the top line to be in the range of 75 crores, and their margins would be very much in line with the Kilburn engineering margins as well. With both these plans together, we expect that we would, in the coming years, we would be able to achieve 500 crores plus. For the next financial year, we expect our growth to be in the range of 25 to 30%. As far as the inquiry pipeline is concerned, we have inquiries worth 1,000 crores across various verticals like fertilizers, carbon black, chemicals, petrochemicals, etc. Overall, I can say that we are very much on the path to our vision of 2025. That's all from my end. Thank you.
Thank you, sir. We'll now take questions. Anybody who wishes to ask a question may use the option of raise hand. I already have an option taken by Mr. Garvit Goel in the chat. Garvit, you can unmute and ask your questions.
Hi, congrats for good set of numbers. My question is on the order book.
On the order book, well, the order book as on 30th September is 214 crores, and we expect orders of around 250 crores plus in the next 6 months.
That thing I understand. I want to understand what is exactly driving the demand for our products. Like, is it due to any structural changes like China plus one, or if that is the case, please share the percentage of export order that we are having out of this current order book.
Well, I would say that China plus one definitely has an impact, a positive impact, I should say, both on the domestic and the international market. As far as the breakup is concerned, of course, there are multiple other reasons, which also contribute to the order intake. But as far as the export market is concerned, I think our order book is in the range of, Sachin, do you have the numbers with you by any chance? What is our current?
The pending orders are around 8 to 10% are export orders.
Yeah, around 10% are export orders.
Okay. And you mentioned in your press release that we'll do INR 400 CR in FY24. So to achieve that, we are required to do INR 260 CR in second half. So even if I add the inorganic acquisition revenue, say 30 CR for I think it will be added for 3 months only. So we will still be required to achieve 230 to 240 CR kind of organic revenue. So, but we have an order book of right now 214 CR only. So how will we are going to do that?
We are expecting a number of orders in Q3, and a part of it would definitely be executed in the current year.
So, including the inorganic numbers, we are still guiding for 400 CR in FY24, right? Is that
Right.
correct? And the EBITDA margins of 20%, right?
Yes, in the range of.
And in your opening remarks, actually I was not able to hear. You mentioned, I think, closing order book as well. So, what was that number?
The closing order book on 30th September, you meant, or?
No, actually, at the end of the year, expected closing order book by the end of the year.
Well, we would, I did not mention that number, but I would expect that we would have a closing order book again in the range of 200 plus crores.
Okay. And can you tell us also, like in your presentation, it is mentioned like ME is having a strong order book of, I think, 110 CR. And in the opening of the year, I think they were having 58 CR. So what is exactly happening there? Means how the demand is coming drastically for them?
Well, the products and solutions which are offered by ME Energy, are highly customized and they have a niche market. And we are seeing a lot of projects coming up in the thermal power plants, in cement industry, and that's one of the biggest contributors for the orders.
Okay, so if currently I think they are having 110 CR kind of order book. So in second half, what kind of orders do we expect on their side?
I would not be able to answer that question now, but they too have a very healthy inquiry pipeline.
Okay. And can you spare a few minutes on sharing the competitive landscape which the company is having? Like who are our competitors in India, and what is our market share, and what kind of edge do we have against them, against the peers?
You want the competitors for Kilburn or for ME Energy?
For Kilburn.
For Kilburn, we have competition across different products. So I would say that as far as rotary dryers are concerned, we have competition from China and Germany. And as far as tea dryers are concerned, we have competition from the local players. So across different products, we have different competition.
So what kind of edge that do we have, which will drive the growth for us against the peers, and we will be able to have an increased market share going ahead?
Yeah, so the edge which we have as Kilburn is basically we come with a background of 40 years of experience, yeah, which very few companies have. And at the same time, I would say that the depth of manufacturing that exists in our company in Kilburn is very high. When I say depth of manufacturing, I mean is that the kind of manufacturing processes that we have, yeah, that is something which not everybody has in our competition.
So is it like any kind of technology advantage do we have against the peers or anything like that?
Yes, you can say so.
Okay. And so on the margin front, we are at all-time high EBITDA margins. So here in 2017, we achieved 17%. So here I want to ask two questions. One is why after 2017 our EBITDA margins fall drastically, and secondly, if I look at the current margins, so how sustainable these margins are, which we are currently doing, and why?
Okay. Hello.
Yes.
Yeah. So why our margins have been higher? Well, we have currently been executing some of the projects which are in the high margin range, which we had bagged in the last quarter of last financial year. So that is one of the contributors. Then a couple of projects which we have been doing at site, which are more labor centric. So we have seen a little higher margins over there as well. Yeah. And going forward, we expect that this margin will be maintained in the next 2 quarters at least.
Actually, if I look from a perspective of 2, 3 years, so how sustainable are these margins? That's what I was asking for.
Well, it all depends on the kind of order intake we have from time to time. And we are in the process of ensuring that we maintain our operational efficiencies. And we expect that we will maintain this. Well, if you were there in the last investor meeting, we had mentioned that we would be targeting 17 to 18% of margins, but we have now reached 20%. So we expect that we'll maintain that.
And what was the reason for fall in the margins after 2017?
Sachin, can you
Margins, it depends on type of orders we take, the order mix which we execute. So recently we have taken very much value-added orders where the cross margins are at quite a high level. So it depends on the type of orders. Even in the same equipment, we have different type depending on the composition of material or the customized requirement of the customer. Margin keep on varying. So presently, what orders we are executing and what we are targeting are orders with a good gross margin. So we expect to maintain this overall 20% EBITDA margin across the board.
So actually, I agree
Sachin,
with the previous.
if I can just add regarding the 2017 numbers, I think the query is that why after 17 we also dropped. You see, now the company's economies of scale is significantly higher. The turnover in the first half is higher than what our total turnover was during those years. And then post that you had COVID years when the turnover had significantly dropped. So it's not comparable to the earlier years in terms of.
But actually, that fall was drastic one. I think from 17% to it was 4% kind of a EBITDA margin. So that's why I was asking for. It is not. I think it is not a product mix thing. I think it can be a different reason also. So that's what I was asking.
Sure. Thanks, Garvit. We'll move to the next question. Pratik, you can unmute and ask your question.
Yes, hi, good afternoon and thank you. So first of all, congratulations on a very good set of performance.
Thank you.
Yes, so again, looking at your company after a long time and so broadly, what has changed? I mean, we are reporting one of the highest growths in our history. one of the best margins. So from an industry perspective, I mean, we have seen a lot of tough times in last many years. So now that we are out of it, I mean, from an industry landscape perspective, if you can qualitatively highlight what has changed.
Right. So from the industry landscape perspective, I would say that earlier we were more of a product provider, or we used to sell products, but nowadays what we offer is solutions. Okay. So if you look at, our products maybe a few years back, what we were offering was calciners and rotary dryers as products. But today what we offer to the industry is a solution. So that also means the balance of plant, the peripherals, and and the reason why we are able to do all that, that we have changed our whole strategy of go to market. What we are doing today is we are tying up with the customer when they are already on the drawing board and not later when they really want to buy the product. So we offer our services from that stage, and obviously when you're working closer with the customer, you stand a better chance of winning the race. So this has been one of the important things. Second thing is that we have diversified into various products. Like recently we added air preheaters to our portfolio. Then we have seen different applications for paddle dryers, which were earlier only offered for a specific application. Now we have, enhanced our product and we are looking at more applications. So this also increases our market penetration. So there are multiple reasons. And this is from the industry landscape perspective. As an organization, definitely we have become a lot more aggressive in our sales approach, and a lot of things are done where, I mean, we do a lot of pre-project selling instead of just waiting for the projects to come up. So that's also been a paradigm shift in the way we have been working as an organization. And over a period of time, we have built up a good human resource in the organization with different skill sets across in project management, in manufacturing, at every stage. So all this together contributes to higher turnover and higher margins subsequently.
Correct, sir. And anything from our end customer side or from a competition side, anything which has changed? I mean, one, you mentioned that internally we have made a lot of changes. We have changed the approach, changed our strategies. But say from a customer end, are you seeing more projects coming up, more demand? Similarly, there were a lot of players in the past who used to compete with us. We could survive and come out of it stronger. Are they out of the market? So anything on that?
Well, you will always have competition around, and it's like who runs the fastest. I mean, that's the way it goes. So far we have been able to beat our competition pretty well. And I said, I think the biggest advantage that we have had is that we work with the customers in the pre-project stage itself. So that really helps us. Now, does that mean competition will not catch up? Yes, definitely they will also catch up over a period of time. But we will create our own niche from time to time.
Correct. Great. Thank you and all the best, sir.
Thank you.
We take the next question from Chinmay. Chinmay, you can unmute and ask your question.
Hello, am I audible?
Yes.
Yes, hello, sir. Thank you for the opportunity and congratulations on a great set of numbers.
Thank
So,
you.
just a couple of questions. First, in relation to the order book, so the fact that you mentioned solutions. So, as a part of the entire order book, what part of the order book are we doing at site? Because we forayed into fabrication of certain critical equipments like silos. So, are there any other orders that have come in into our order book?
Right. So we are at the advanced stage of discussions with some of our customers. And this would be a combination of the orders being executed in the factory as well as the site.
Okay. So can you give me a bifurcation in terms of numbers as to as in the services we are providing at site versus not?
For the current financial year, maybe Sachin can throw some light on that.
I think out of the pending orders of around 230 crores, around 30 crores of orders are being done at site.
Okay, okay.
And this mix could change from time to time.
Okay, okay. Got it. And so the next question was in terms of, we had mentioned earlier, is there any bottleneck we are facing in terms of conversion of inquiries into orders right now?
Well, there will always be some challenges from time to time, ma'am. And, it's not that we are in a seller's market. So price is always, we have to be very strategic in our pricing.
Right. Okay, got it. And so lastly, earlier we had mentioned that there are certain EOT cranes that were to be delivered to our facility. So has that already arrived for usage? And is there any other, kind of amount that we have further expansion we're looking at in terms of the execution capability we have?
Right. Thank you for that question. Yes, those cranes have arrived and very much in operation. As far as the future capex is concerned, I would expect that our capex for next year would be in the range of 15 to 20 crores. This would include expansion of the acquired facility in Pune. So we expect some capex to be deployed over there and also in our current factory. So that's very much on our next year's budget.
All right, all right. Thank you so much, sir. That was very helpful. Thank you.
Thank you.
We'll take the next question from Guneet Singh. Guneet, you can unmute.
Hi, sir. So the acquisition that we are proposing, by when do we expect that to be completed? And by when can we expect the revenues from from that flowing into our consolidated revenues?
We expect the acquisition to be completed by December 2023. So it's a 100%
December
acquisition.
2025.
23. As in
2023.
this quarter, in the current quarter.
All right. And sir, what kind of annual revenues does that company generate?
Well, we expect them to generate in the range of 75 to 100 crores in the current year.
All right. And
And
sir, yeah, please go ahead.
And the combined revenue which we see ourselves to have is 450 to 500 crores in the coming years.
All right. Sir, and for the current year, I'm sorry if I missed the opening remarks. You mentioned that we would be achieving 300 CR plus revenues in a standalone business, right?
Right.
All right, sir. That's all from my side. I'll join the queue again. Thank you.
Sure. Thank you.
We'll take the next question from Naveen. Naveen, you can unmute, please.
Good evening. Thanks for the opportunity. I just want to understand what is the split up between the process equipment and fabrication in our revenues approximately?
So when you talk about fabrication, are you referring to the site fabrication?
The overall, sir, we might do it in our base also.
Okay. Well, that depends on project to project. It is, it's never a fixed number, but you can say that 20 to 25% of it would be outsourced. Anil, can you throw some light on that, Anil? Anil, are you there? Yeah.
Yeah, I'm there. Naveen, your question, I believe, is you are asking exactly. The question is how much of the percentage is process equipment, how much is the fabrication revenue, right?
That's correct, sir.
Yeah. So majorly we deal in only process equipment.
Okay.
But when we talk about fabrication, what we spoke about the silos, we have taken that, although it is a process equipment as such, but to reduce the risk, we have taken it as a fabricator. The job has been taken as a fabricator. However, we are involved in the design validation of these silos. So you can say there is, value addition as a design consultant plus a fabricator on site. I hope I have replied to your question, but in percentage, I would say around 20 or 15% of our revenue is only fabrication.
Got it, sir. Very helpful.
Yeah.
And what percentage is recurring revenue from repairs, maintenance, and such contracts, sir?
See, we are not focusing right now on any such kind of job. However, the equipment we provide to our customers, basically they have their own maintenance team. So they don't opt for any annual maintenance. However, for the tea industry, we do offer AMCs. And this is for, you can say, almost 70% of our equipment. We have these AMCs, but they are not revenue generation oriented. They are more of, to keep us alive in the market and kicking.
Got it, sir. Got it.
Yeah.
And in the revenue projections for the current financial year, we have put out a number of 400 crores. Is that including the new acquisition, or is it just the current setup only?
It is including the new acquisition.
Okay, sir. Thank you. Thank you, sir.
Thank you.
Thank you. We'll take the next question from Darshil Zaveri. Darshil.
Hi, hello, am I audible?
Yes, Anshul.
Yeah, so good evening, sir. Thank you so much for taking the question, sir. So just most of the questions have been answered. Just wanted to clarify one thing. So, sir, we are expecting 300 crores on a standalone basis. So, 100 crores of console revenue, but that would only be for 4 months, right, of ME Energy. So, I'm sorry, what would be the annual run rate we expect from ME Energy?
Well, you're talking about the current year for ME Energy.
Current year or maybe FY25, what do we expect from ME Energy? ME Energy current year, what would be the run rate that we can expect of it to be?
This year, we expect it to be in the range of 75 plus crores. And definitely going forward, we expect it to be in the range of 100 plus crores.
So, sir, just wanted to clarify 300 crores we are expecting on a standalone, and ME Energy, if it's doing 75 crores, then it would add around 35 crores of revenue for our console basis. So 400 crores, just wanted to, reconcile that because, you could help me out in that.
Well, what I mentioned is that we would be in the range of 300 plus crores and they would be 75 plus crores. So we are targeting 400 crores jointly as of now. And going forward, we are definitely working on achieving 500 crores by having an expansion over there. I mentioned some time back that we are having some capex plans for their factory in Pune. So all in all, I expect that we would touch 500 crores by 2025.
Ranjit, I think Sachin can clarify here. When we talk about ME Energy's revenue, I'm guessing that post the integration and becoming 100% subsidiary, the total full year's revenue will get consolidated.
Yes.
Sachin, please confirm that.
Because first half they have not achieved any car. So by the time we achieve that, the 75 major turnover is expected in the last quarter.
Okay. That helps.
Yeah.
Okay. And so we're talking about 25%. So in our standalone entity, we would have around 25% growth, and ME Energy will also be growing at a similar rate, right? So on a combined basis, 500 crores achieved in this.
Yeah, so we will have a combined growth rate of 20 to 25%.
Perfect, sir. And so with such a high growth, so what other capex are we looking at? Our facilities and capacity utilizations are enough to be able to maintain, or how would that be, sir? So will we need another major capex?
Right. So as I mentioned that we are anticipating a capex of 15 to 20 crores. Most of it would be for the expansion in Pune since they have provision for expansion. And there could be some capex in Kilburn at our current premises. So those final details will be worked out in due course of time.
Perfect, sir. So most of my questions have been answered. All the best, sir. Congratulations, sir.
Thank you.
Thank you.
Thank you. We'll take the next question from Alicia. Alicia, you can unmute, please.
Hi, sir. Good afternoon. Thank you for the opportunity. So, firstly, this order book of 212 crores, this is executable over what period?
The current order book, open order book, you're saying?
Yes.
Most of it would be executed in the current year.
So, typical execution cycle would be 6 to 8 months?
Right. Depends on the product. Sometimes it is 3 to 6 months. Sometimes it can go to 10 to 12 months.
Sure. And earlier in the call, you were mentioning that the order inflow for the year we're expecting is 250 crores, or for H2 is 250 crores?
For the H2 is 250 crores.
Okay.
250 to 300.
And
based on our inquiry pipeline of 1,000 crores.
okay. And the silos order that we had received, what was the size of that order and how much is currently executed?
Sachin, I would need your help over here.
The order was around 42 crores. So around 24 crores is yet to be executed.
And that will be executed in this year?
Yeah, yes.
Sure. And just a question on ME Energy, if you can just help us understand that, if there's a waste heat recovery plant, what is it that we are supplying? What would be part of our scope of work here?
Right. Our scope would start right from the engineering, yeah, and whatever equipment needs to be built both in the plant and at site. So all that would be a part of our scope. So it could be some equipment, it could be some services, engineering services. It depends on project to project. These are all customized projects.
Is it possible to quantify, say, for a plant that costs, say, 100 crores, what would be our addressable portion over here?
Anil, I'll need your help over here. Anil, are you there?
To quantify on the aspect of, ma'am, are you speaking about the ME Energy only?
Yes.
So if the plant cost is 300 crores for a waste heat recovery solution package, see, normally I would say, the power plants, the thermal power plants, the cost is much more higher. It's in the range of 4,000 crores. Okay. So in terms of percentage, with respect to 4,000 crores, waste heat recovery would be around, let's say, somewhere around 5%. Not more than that. But there is the ROI on this spending by the thermal power plant is estimated at around 18 months to 2 years. So it is quite attractive for a power plant.
Okay. And this entire 5% is what we would be catering to. It would be part of our scope of work we would bid for.
Yeah.
Sure. Are we witnessing any slowdown in order inflow? Because if I look at the run rate, or even what it was last year and the kind of inflow that we're targeting, are we witnessing any kind of slowdown?
Well, I think these situations come in the market where you feel a slowdown and then suddenly a spate of orders close. So it's very subjective. As of now, we are not seeing a slowdown. We expect a good Q3, Q4 in terms of order booking.
Or if I could just put it differently, in the order inflow that we saw last year of about 350 crores, was there any one or two big orders which helped us, which made the order inflow very, very strong?
Yes, definitely there were one or two big orders, and we expect the similar situation will happen in this year also.
Okay, I'll come back in the queue. Thank you.
Thanks, Alisha. We'll take the next question from Richa Agarwal. Richa, you can unmute and ask your question.
Audible?
Yes.
Yeah, thank you for the opportunity. Sir, I just wanted to, follow up on a previous participant's question about the volatility of the margins. So I just wanted to understand, when you're bidding and when the order book is there, so what kind of margins are you considering the minimum viable margins for yourself? And I mean, the reason for expansion of your margins is because of, certain big order inflows, or is it the raw materials? And, if you could give us some visibility in terms of sustainability of these kind of margins, please. That would help.
Sachin, can you take that?
Yeah, definitely. See, usually our margins in most of the orders range from around 35 to 45%. So certain big orders which we had got at good margins during the last quarter of the last year have come into execution during this current quarter. That is one of the reasons for the higher margins as well as the higher EBITDA. Additionally, as Mr. Anil said, this site work also, which we are executing, that has also taken a leap during this quarter, which has also given us a good margin during this particular quarter. And going ahead, we target mostly what orders are in the pipeline are more or less in the same range of gross margins. So based on that, we hope to sustain this. Hope means we will definitely sustain this EBITDA margin of around 20%, going by the trend or what the inquiries are in hand and what we are addressing presently.
Okay. And sir, also in terms of receivables, like I was looking at your receivable days and they seem to have, like they were more than 100 days and now they are at 70 odd days. So if you could help us understand what is helping to bring this down and what can we expect going forward based on the current order?
Each receivable, each customer has a different order terms. Many of our customers, the last 10% is held back because of the commissioning, not commissioning of the plant. So though we have supplied everything, the last amounts are held back because they have not yet commissioned their plant. So most of the commissioning activities and quite a few of our projects are over. So that has brought down the receivable levels. And we have also been vigorously targeting, having specific focus on collections. And that is how it has been. We have managed to bring it down.
So where do you expect, based on the current order book and kind of execution that you have? Because I'm not sure of the retention part of it. So where do you expect it to be in FY24-25?
See, with the order book and top line growing, definitely your debtors are going to be higher. At the end of the most of our dispatches or sales are concentrated in the last quarter. Now, even in this half year, during September itself, we have dispatched around 50 crores. So naturally, at the end of the year, your debtors are bound to be high, but that is not indicative of their collection cycle or the debtors number of days cycle. So it is very,
I mean, would you say that it would be more of around 80 days or it is likely to be around 100 odd days? I mean,
it should range between that, say 2.5 months of sales.
Okay. Yeah. Okay. And sir, could you also share about, the consideration for acquisition of ME Private Limited?
Total consideration is 99 crores, out of which 23 crores will be by way of issuance of swap of shares, Kilburn shares, as I stated in our EGM notice. 14 lakh shares will be issued and balance will be by way of cash, for which we are raising the funds through a private placement, preferential allotment of shares and warrants.
Okay. And sir, just one more question. Like in your shareholding pattern, there is some kind of selling by a certain promoter. So, I mean, which group that belongs to, post the restructuring now that we have two promoter groups? And is there further sale expected? The promoter stake, is it likely to come down further?
Amritanshu, can you take that question, please?
Yeah, so at the moment, the total promoter holding is at about 50 odd percent. We believe that the promoter stake should continue at these levels going forward. As of now, there's no plan for any stake sale to take place.
Okay, and the sale that happened, that was from Khetan Group?
That was from the Williamson Mega Group.
Okay. Okay, thank you so much.
We take the next question from Bharat Gupta. Bharat, you can unmute and ask your question. Bharat, we cannot hear you. We'll move on to the next participant. We'll take the next question from Dhiral Shah.
Yeah, good afternoon, sir. Thanks for the opportunity. So, with the acquisition of ME Energy, since what I come to understand that ME Energy is more into the waste heat recovery side. So, just wanted to know, sir, if you can explain how this will complement our existing business, since we are more into the product dryer side, sir. So, what is the synergy, by acquiring this business, and how we can cross sell our product?
Right. So if you look at the customer base, most of the customer base is similar. whether it comes to petrochemicals, whether it comes to chemical industry, and what they carbon black, soda ash, and what they have in addition is probably the food and beverages. They are well placed. Now, if you look at all the projects which are coming up or expected to come up, most of them would need dryers for their projects, and practically every project also needs a waste heat recovery system. So from that perspective, we see that we have a wider product portfolio to offer to all our customers. So that's where, as a group, as a as a partner, as partners, we have more to offer to the customers. And there is no overlap of the products as such. What they have is unique in its own way, and what we have is also unique in its own way. So that's how we augment each other.
And so, who are the competitor of the MA Energy?
Their biggest competitor, I would say, is Thermax. But
Okay, so what?
But MA Energy has created a niche for itself by offering customized solutions.
Okay, so what is the revenue potential that ME Energy can achieve in the coming years, and the kind of capex that we are doing in FY25, 15-20 crore, what additional revenue we can deliver?
Well, as I said earlier, together we are targeting a revenue of 500 crores plus. If you talk about the split, it would be in the range of 80 to 20%.
Okay, so 20% from ME and the rest from the.
Yeah, but it could vary. I'm just giving a ballpark figure.
Okay. Thank you so much, sir.
Thanks, Dhiral. We'll take the next question from Karthik Bhatt. Karthik, you can unmute, please.
Yeah, am I audible?
Yes.
Yeah. Thank you for the opportunity, and congrats on a good set of numbers. So you mentioned in your presentation about new and niche areas of application in addition to chemical, petrochemical, and so on. So if you can throw some light on which are these areas and who are the players addressing this market currently, and what is our entitlement to win, and so on.
You're referring to Kilburn portfolio?
That's right, sir.
Right. So what we are targeting is APA market. That's one. Secondly, we are targeting projects where work is to be done at site. We just mentioned about the silos. So this was the first time we had done in the current financial year. We expect to expand that portfolio as well. And apart from that, we are looking at air preheaters market.
Okay. And I think in the last earnings call, you were mentioning about US and Europe markets being serviced through a regional tie-up, and you were planning to set up your own team. So any update on that, or how is that looking currently?
Right. So, whilst that is an ongoing process, but we have been very focused on the Indian market since there has been sufficient business, and we have to take a call where to put our energies into our resources. So as of now, we are well placed in the local market, and gradually we'll also get to the international market. But that's definitely something on the radar.
Okay. And ME Energy, how much debt do they have on the books currently? Is it substantial or?
No, it is mostly their borrowings are for non-fund based limits. So they have a very paltry bank exposure in.
Okay, sure. And I just wanted to check, are we eligible for PLI benefits currently, and are we getting PLI scheme benefits currently?
Sachin?
Can you please repeat the question? I didn't get that.
PLI scheme benefits, are we eligible for those, and are we getting those currently? What's the magnitude if yes?
No, we are not getting this.
Okay, sure. Thank you so much.
Thank you. We'll take the next question from Varun Agarwal.
Thanks for the opportunity. Congratulations, Mr. Lala and team, for the wonderful set of numbers.
Thank you.
This acquisition, what we have done, the margin profile of this company is higher than the existing business. Is my understanding correct?
Can you kindly repeat your question, Varun?
new acquisition, what we have done, is the margin profile in that new business higher than our existing business?
Well, I would say it's in the same range.
Okay. Thank you so much.
Thank you. We take the next question from Kunal Tokas.
Hi, sir. Bharat this side from Payval Capital. First of all, congratulations for a good set of results. So a couple of questions. First, in regard to the domestic sales. So I believe we are majorly like 85% of our order book is primarily towards the domestic market only. And there 50% of our book is exposed to chemical sector directly or indirectly. We are seeing that there is a good amount of headwinds which are seen across the sector, and the capex intensity with respect to chemical sector that is going on a deferment kind of a way. So are we seeing some sort of an impact in terms of the overall bids which are allocated in the market? So there is some sort of an impact which is coming in place due to this?
Well, if you see a little bit of headwinds in chemical, then I can say that the petrochemical segment has good opportunities. So in the past also I have mentioned that the growth that we are seeing in the next 5 to 7 years in petrochemicals and chemicals, of course, is varying from 7 to 10%. But at some point of time, one of the verticals is doing pretty well. So that's where we keep focusing our efforts. So these things will happen. Sometimes the chemical industry will have headwinds. Sometimes there'll be a lull in the petrochemical industry. Sometimes there'll be few projects in the carbon black, but something or the other is always there for us to target.
But overall, if you look on an annualized basis, so the kind of order book which we are maintaining, so we are able to grow it at a CAGR of 25%. That way we are comfortable.
As of now, yes, that's how we see ourselves.
And sir, just talking with respect to the strike rate. So eventually, I believe 4,000 odd crores of tenders are generally floating the market on an annualized basis. I'm talking with respect to the overall industry, if my understanding is correct. So there, what kind of orders generally we focus upon? Are we focusing on kind of projects where the margins are over 20%, or there is some sort of a customization which is required, or we generally focus on the kind of like the across the bids we primarily focus upon, irrespective of the margins?
Right. So it's like this, Kunal, that we definitely focus where we have a niche for ourselves. So when you talk about places like soda ash, carbon black, petrochemicals, or chemical industry, we have a niche market. As I said, we tie up with the customers at the pre-project stage, right from the engineering stage, and we support them with all the necessary inputs. Okay. That's how we keep ourselves strongly with them, in a strong relationship with them. Now, you are talking about 4,000 crores pipeline. We don't target 4,000 crores pipeline. We are very clear that we will target around 1,000 to 1,500 at any point of time. And there too, we do participate in, probably 1,000 crores inquiries. But when it comes to focus, we are very clear what we need to choose and pick. So we always focus on places or on projects where we have higher, or we expect to have higher margins, but not necessarily that it works in that direction all the time. But our focus is on the high margin projects. And if we feel that we have secured enough, then we can also get to the next level of projects where we have little lower margins, so that we have the economies of scale to help us out. So that is something which we review from quarter to quarter, and I think we have been fairly successful.
And so the kind of orders we focus upon, so what kind of a strike rate generally is there for us?
Well, I would say in the range of 30 to 40%, just a ballpark figure.
Also, sir, just wanted to check, like in terms of our export strategy. So, what kind of are we empaneled with some EPC players, and what kind of a strategy we have in place for growing export?
Right. So currently, if you look at our exports, we have done a lot for companies like Birlas and Tata Chemicals. We are working closely with them. As far as the EPC is concerned, we have not really directly tied up with them, but all the international EPC companies in India, definitely we are well placed with them, like the Technimons, then Technip, and many others. So once you're qualified with them for the local projects, it is only a little bit of more effort in getting qualified for the international markets. But as I said, right now our focus is to bag as many orders in India.
Just a last bit from my side, and that is on the margin side. So as you said, 20% kind of a margins are we working upon. So generally, sir, as per my understanding is concerned, so we look on per ton basis, whatever kind of a material which we are supplying, or whatever kind of equipment which we are supplying, majority of it is commoditized in nature, and particularly the margins we enjoy is primarily on the processing front, right? So EBITDA per ton kind of a framework we generally work upon, whether we look out for any kind of a bit or it is somewhat different.
Right. So not all our material is a commodity. We specialized in fabrications of exotic metals like inconel titanium, and that's where we have higher margins. So that's also our process capability that we have, which leads to higher margins. And what the customer sees is in totality. Okay, they don't see that so much portion is a commodity or so much of a portion is a high-end material. That's not the way they see. They see our capabilities, and that's how we maintain our margins. So our margins are not linked directly to commodities.
Right. And what steps we are taking in terms of migrating further into the value-added side?
Sorry, and I beg your pardon. Can you repeat?
Sure, sir. I was just asking with respect to the product mix, whatever steps we are taking in order to maintain the margins, and particularly, is there a change in the product mix, and we are venturing further into the value-added side?
Well, I think we are already well placed in the value-added side. Yeah, and that's how we expect the margins to be maintained. On the product mix, I would say we have one more product, which is the tea dryers, and definitely the margins are low over there. So, and then we have the paddle dryers where they are reasonable. But most of our equipment is with reasonably good margins.
Sure, sir. Thanks, sir.
Thank you. I would like to invite Bharat Gupta to ask his questions. He's having some issues with his mic.
I think I've already asked. I asked
Okay, that was you only. Sure. Thanks. We'll proceed to Sanchit Chawla. Sanchit, you can unmute and ask your question. Sanchit, we can't hear you. We'll go to the next participant, Sarvesh. Please unmute and ask your questions.
Yes, sir. So congrats on a great quarter. Sir, my first question is on the inquiry pipeline. So up till last quarter, we used to say we have an inquiry pipeline of around 700 crores. And now we are suddenly at 1000 crores, which is a sizable jump of 40-45%. So what has led to this? If you could explain.
Well, you have the business happening in the market, you have projects happening. So, that's how we have the inquiries coming in.
Okay, so it is only the demand is so good from the market.
As of now, yes.
All right. And sir, you said that the value added mix in our order book is quite high this time. That is why we are able to do 20% plus kind of EBITDA margins. So what is leading to this better value added mix? Anything different in the market?
No, but what we mentioned earlier was that the projects that we are currently executing in this quarter or at the last quarter, they were the projects which we had bagged at higher margins. Yeah, so overall mix has given us a 20% margin, and we expect this to continue.
All right, sir. Sir, in previous call, we have said that our on a standalone basis, our peak revenue could be 450 to 500 crores. And according to our projections, next year we should be around in that ballpark. So, do we have any sizable capex plans?
Well, first of all, no. If you're referring to the previous call, I think we had said that our vision is to reach 500 crores by 2025. And that time, ME Energy was not on the cards, and we said we are looking at all options of both organic and inorganic growth. Now that we have taken a step forward, we expect that we will meet our vision of 2025. I hope that answers a part of your question. Coming to the capex, yes, definitely. I did mention a while back. We are looking at a capex in the range of 15 to 20 crores. A part of which would be for the Pune factory, because we have provision for expansion, and a part of it would be for our existing factory. And the final details are being worked out.
All right, sir. Thanks, sir, and all the best.
Thank you.
Thank you. We'll take the next question from Richa.
Thank you for the opportunity again, sir. So my question, I think in one of the previous calls you had mentioned that your export margins are a bit lower than the domestic, but if you could help us understand the gap between the two. Uh, I think your current revenue mix is 20% from the exports, and also what is the mix in the order book, if you could highlight that.
The mix in the order book, I would say right now our export order booking is in the range of 10%. What I had mentioned is that it could vary. It's not necessary that we always have lower margins on the export. It's again, from time to time, it changes. You could also, I mean, at some point of time, it's possible that you might have higher margins. But as of now, I think what we are having is an average of 20%. Let me put it that way. It would be difficult to further dissect it as to, how much is it exactly in the exports and how much it is for the local market.
Okay.
These are
And
very
sir,
dynamic things. These
yeah.
are very dynamic things, and we are very much in control of that.
Okay. And sir, going forward, if you could also help me understand, what kind of capex do we need to put up for a certain, order quantum or incremental revenue? Is there a percentage to it?
I cannot give an exact percentage, but what I can say is that we have done an assessment as to what is the kind of capex is expected from our end in the next 1 year. And I mentioned it would be in the range of 15 to 20 crores. And plus minus, I mean, it could be even more than 20 when we work out the final details. But most of it would be for the Pune factory. And we are
Okay,
very
thank you.
that we are targeting 500 crores for 2025. I mean, that's our vision. I think that's something which I have told you in the previous call, and I've also mentioned before that when I've met some of you in person.
Okay, thank you and all the best.
Thank you.
Thank you. We'll take the last question for the day from Shubham Thorat. Shubham, you can unmute and ask your question.
Yeah, can you hear me?
Yes. Sure.
Yeah, thank you for the opportunity. And my first question is that I just wanted to pick your thoughts on what is the current situation on the raw material side of your costing, and how do you expect it to be coming couple of quarters?
Sorry, Sachin, can you take that?
No, I could not get the question.
Yeah, can you kindly repeat your question, Shubham ji?
Sure. So, I just wanted to ask, what is the current situation on the raw material costing front for the company, and how do you expect it to be behaving in the next couple of quarters?
Well, we don't see any major, changes in the raw material cost. I think they are very much under control. And as far as the costing is concerned, definitely when we do our costing, we do it, at that point of time. And at the time of finalization, we review our costs. And if we get the orders, we immediately book back to back with our suppliers. So that is very much in place now for more than a year and a half.
Got it. And so lastly, so I believe your current export mix is 20% of your revenues. So, sir, is there any internal number that you want to adhere to while targeting the export? Is there any number targeted for the as a percentage of revenues for the exports?
Currently, as far as I understand, it is 10% of our order booking, and it could vary, from time to time. But we expect that on an average, we would be in the range of 15 to 20% in days to come.
Got it. Sure. Thank you for the opportunity so much again, and wish you all the best.
Thank you.
So we'll take one last question that has come on the chat from Mr. Keshav Kumar. Is
Sure.
the waste heat recovery equipment largely catering to greenfield, or is there a large conversion demand also present, where the existing plants add these equipments, and where is the current demand in this regard coming from in our acquired company?
Right. So definitely, it is both in the greenfield projects as well as I would say the retrofits, where people are looking at reutilizing the heat that is generated as a part of process. So that's the reason why you have process boilers and heat recovery systems. So that is something which we offer. As of now, ME Energy is offering to its customers, even for the brownfield projects or their existing setups. Now, where is it coming from? It's coming from across various verticals, and to the best of my knowledge, they have some very good customers in the food and beverage business, apart from others. But they are very strong in the food and the beverage business, in the thermal power plants, cement industry. This is their forte.
Right. Thank you, sir. That brings us to the end of this conference call. We thank the management for giving us their valuable time and to all the participants for joining us on this call. You may all log off now. Thank you, sir.
Thanks to all of you, and wishing you all a very happy Diwali in advance.
Thank you, sir.
Thank you.